Netflix delivered almost exactly what it promised, and the stock dropped nearly 9%. Revenue up 13.4%, profit up 11%, every headline number inside management's own forecast. So why is it trading through its 52-week low? Welcome back to Wall Street Holics. Markets, shares, options. This is research and education, not financial advice. We're walking through Netflix's Q2 fiscal year 2026 earnings review, as reported after market on the 16th of July 2026. The print, the reaction, a cash flow distortion nobody's discussing, and what the shares are actually worth. $67.78 overnight on July 17th, down 8.8% from a close of $74.35. Straight to the point, our call, buy, with a fair price target of $76.40. And here's why. First, the engine, return on equity, 48.1%, return on invested capital, 34.9%. The profit squeezed out of every dollar of capital in the business. Very few companies live in this space, and Netflix is one of them. Free cash flow margin, 23.1%. Net debt, just $5.24 billion. Then the number everyone is fixated on. Revenue growth of 13.4%, the fourth straight quarter of deceleration, elite economics cooling top line, that's the tension. The summary, the business did what it said it would. Revenue $12.56 billion, operating income $4.19 billion, earnings per share 80 cents, margin ahead of the company's own guide. Then Netflix guided next quarter to $12.86 billion against roughly $13 billion expected, and the shares fell as much as 9%. Our read, the deceleration is arithmetic, not decay. A weak dollar and paid sharing flattered last year, both are lapping. Against the guide, revenue in line, operating income slightly ahead on expense timing, earnings a cent above consensus, free cash flow down 32.7%. That's a cash tax bill, and we'll get there. This is the most critical point, and why we believe Netflix is a buy for the second half of 2026. Margin slipped 70 basis points because content amortization is front-loaded into the first half, but the revenue bars have never gone backwards. What changed is the slope, and the slope is what got repriced. So why 8.8%? A $140 million shortfall on a $12.9 billion quarter erased roughly $29 billion of market value. That's the arithmetic. Now look at the two lines on the graph. The red line showing the reported growth versus the blue line showing the currency neutral. The dollar was doing the flattering all through 2025, and that tailwind is gone. On constant currency, the fade runs from 16.1% to 11%. Real, but 2 points gentler than the headline the tape reacted to. Regionally, nothing broke. All four regions grew double digits. EMEA cleared $4 billion for the first time. Latin America and Asia Pacific each cleared $1.5 billion. The soft spot is UCAN. 43% of revenue, growing just 10%, with a US price rise only partly landed in the quarter. The full effect hits in Q3, so that line should be solid in the next earnings. This is the slide the market completely skipped. Netflix collected $2.8 billion in Q1 for walking away from Warner Brothers, which is why Q1 cash flow spiked. The tax on it came due in Q2, which is why this quarter looks like a collapse. Strip the round trip out, and underlying 2026 free cash flow is roughly $10.2 billion, about 8% growth. Neither the $12.5 billion headline nor the minus 33% quarter is the truth. 5 things buried in the filing. Q1's blowout earnings were a break fee, not a business. Netflix spent 3.1 times its quarterly cash flow buying back stock, funded with that Warner Brothers money. Cash content spend grew 28% against amortization up 12.5%, invisible in margin, fully visible in cash. A $1.5 billion maturity quietly rolled current, and working capital gave back $1.25 billion in a single quarter. Overall, a shrewd management of the balance sheet. 5 more. Live is barely 5% of content spend and 1% of viewing, yet 6 of the 10 best sign-up days in 5 years. That's not engagement, it's customer acquisition hiding in the content budget. Stock compensation is compounding at 78%. Tiny, but the fastest growing expense here. Gen AI now touches around 300 titles. Content obligations reach $25.1 billion, and disclosure keeps narrowing. The positives, each tied to a figure in the filing. Every region double-digit. Operating income ahead of guide. The 31.5% full-year margin target reaffirmed. That implies over 20% operating income growth. Q3 margin guided 500 basis points higher. A record $4.71 billion buyback with $27.1 billion still authorized. And 2 of its biggest rivals about to spend years merging with each other. The other side, weighted just as seriously, 4 straight quarters of deceleration. That direction is unambiguous. UCAN, 43% of revenue, grew 10%. Guidance came in under the street. Strip the Warner Brothers break fee, and that cheap-looking 21.3 times earnings is really about 25.8 times. Free cash flow fell by a third. Content cash outpaces revenue, and this is a downtrend, not a dip. The balance sheet is a fortress. $9.1 billion of cash, $5.24 billion of net debt against $14.36 billion of trailing operating profit, about a third of 1 year's earnings. No dividend has ever been declared, so every dollar of shareholder return runs through repurchases. $4.71 billion in Q2, the largest quarter in company history, with $27.1 billion left. Share count down 2% and equity still grew $3.5 billion. The backdrop. An audience approaching 1 billion means growth is now about pricing, not finding viewers. Rivals are mid-surgery. Non-English content drives over a third of all viewing. Local scale competitors can't rent. Sports is the contested ground. And rights inflation is the biggest threat to the margin path. Advertising, around $3 billion this year, is the first genuinely cyclical line here. Management's forecast, and they're explicit, it's their real internal number, not a sandbagged floor. Q3, revenue $12.86 billion, margin 33.2% versus 28.2% a year ago, earnings 82 cents, up 39%. Full year, revenue narrowed inside the old range rather than cut, the 31.5% margin reaffirmed. Note what they didn't give. No membership guidance, no 2027 framework, no advertising detail beyond that $3 billion. This 10-year model is ours, not the company's, worth saying plainly. Growth fades from 11% to 5% by 2035 as UCAN matures and pricing normalizes. Margins climb roughly 100 basis points a year because content amortization grows slower than revenue. Share count falls about 3% annually on continued buybacks. Nothing in here requires Netflix to do anything it hasn't already done. Valuation, we discount unlevered free cash flow at an 8.75% cost of capital, the blended return debt and equity holders demand, then subtract net debt. That builds an enterprise value of $323.8 billion, or $76.40 a share, and this will appreciate as the share buybacks continue. A conservative 20 times next year's consensus earnings gives $77.20. Our number lands below that deliberately. It hinges most on terminal growth. We expect Netflix to grow at a conservative rate of 2.75% per year forever. The range, built purely by moving terminal growth, half a point either side. Low, $72.35. Mid, $76.40. Our 12-month fair price target, 12.7% above today. High, $81.15, where advertising becomes a genuine second engine. The point, every scenario in our calculations sits above the current price. Nothing heroic is required, only that management delivers what it already guided. So, our verdict is buy. Netflix delivered its guide and lost $29 billion in market cap over a $140 million revenue shortfall. A re-rating on slope, not on evidence. The honest caveat, this is a 13% upside target, not a moonshot 40%. Fair rather than free. It fits a patient long-term holder who can sit through a downtrend and doesn't need income. It's a poor fit if you want dividends or a fast catalyst. We'd sell on a second guide down or any dilution of the margin target. Neither is visible here. Our sentiment index lands at 7.2. Earnings quality, 7. In line on everything, but decelerating, with a one-off sitting in the trailing number. Balance sheet, 8.5. Moat, 8.5. Guidance versus expectations is the weak link at 5.5. Valuation against risk, 7.5. Then a small deduction because shrinking disclosure narrows the independent check on engagement. We publish the confidence, not just the call. The thesis in one line: Netflix didn't have a bad quarter, it had a slower one. And at 21.3 times trailing and 17.6 times next year's earnings, you're being paid to accept a deceleration that was always going to arrive. Our fair value sits at $76.40. All figures are anchored to Netflix's Q2 fiscal year 2026 shareholder letter, filed July 16th, and market data as of July 17th. We ran the same repeatable process on Netflix as we run on everything. The numbers exactly as filed, bull and bear weighted equally, and a confidence level we actually publish. 7.2, not a 10. We cut out the noise and tell you how it is. You are not going to find a more in-depth and accurate overview elsewhere, so if that's useful, subscribe, hit like and share, and give me your comments below on your thoughts. This is a subscriber-led channel. When enough of you ask for a ticker, we genuinely make it. See you in the next video.